I'm Matt Greenwald. I'm joined on the Greenwald side by Brian Perlman and Quincy Payne. Greenwald Research has coffee breaks once a month to give people a short break and hopefully to discuss a subject of interest. And when I say discuss, I mean that we will try to stimulate discussion by presenting some of our research. In this case, we have an idea to bring forward. Welcome interruptions at any time, and we will strive to give time at the end for any comments or questions people may add. We will, as you think about comments, please know that we intend to post this on our website on Monday, which means if one of your colleagues is interested, they can find it and see the whole presentation. Let me try to share my screen, and I hope you can see this. I'm going to go through some research, present the idea. Brian Perlman, my associate, will add some comments from time to time. We were...
Matt, you have a box you have to get rid of.
Yeah, the one that's showing is the...
You have to hit the got it box and get rid of it.
I'm not sure I know how to do that.
Can you put the thing on got it and just click on that?
I don't see that. I'm sorry.
That's what it says.
That's not going to get rid of the whole thing. Maybe minimize the whole black screen because that's not the actual presentation screen.
Oh, does that get rid of it?
That'll get rid of that, and hopefully your presentation's behind it.
Okay, let me try again. Sorry about that. Does this work?
Yes.
And then, yeah, and then present that way. That should be all right.
Okay. Is that good?
Perfect.
Okay, I'll go for, sorry for the slight delay. I want to start by just some context I know you know, but just to provide a context. It was not that long ago that investing was easy because you could, with almost no risk, get a pretty high return. And as we've gone to our current position with extremely low interest rates that the Fed says they'll maintain, I think until 2023, at least they say at this time, it was even better because if you had long-term bonds, for example, the value went up as interest rates came down. And now there's a risk because interest rates basically have one way to go when that is up, which brings down the value of long-term bonds. These are 10-year safe investments, but 10 years, if it's less if you are invested shorter term. And just to talk about the implications of this for investors, Greg Mankiw, a leading economist who was the chair of the Council of Economic Advisors under George Bush, wrote recently, some of the implications of low interest rates are already clear. For example, a balanced portfolio of half stocks and half bonds has historically earned a return of 8.2% or about 5% down from inflation. My guess is that a more plausible projection is an inflation-adjusted return of about 3%. We're looking at the income aspect for retirees who tend to be more risk averse. According to my calculations, to support any given level for a 20-year retirement, the person's nest egg entering retirement needs to be 19% larger, or if they come in with what they've historically accumulated, they're going to get a lot less. And so I think it's clear, whichever way you look at it, investing has become riskier, making effective discussions of risk more important. Until very recently, the risk of equity loss was buffered by dependable fixed investment gains, which were reasonable. And so if you can get 5 or 6%, which was not all that hard in the past, your fixed investments would double over a 15-year period. And even if you were just 40% fixed invested in fixed returns, with a return in a fixed investments return of 5%, it would provide over 5 years a 10% in buffer against investment loss. So there was a buffer in place, and even small gains in equities would provide reasonable rates of return. But now, with the fixed part, if you have a significant investment in the fixed part, and often people like 50 or 60%, you have a choice of keeping that traditional asset allocation with a greater risk of not meeting investment return needs, or increasing allocations to equities to get that return, which means increasing risk, or using techniques that have been, and some of them newly refined and developed, such as downside protection, which adds to complexity, but has a lot of advantages, which I will try to point out. Now, in response, in research our firm has done with advisors, we see that there's strong agreement, there's a strong level of concern that fixed investments will not generate sufficient concern for clients, and 84% and a half of clients agree that that fixed investments will not generate the concerns that they need. It's still a strong belief that fixed investments are still an essential part of diversifying your client's portfolio. 83%, basically, again, of clients believe that, almost 2/3. I'm not sure that's entirely true, but there's still a belief in that. But there is a belief, almost half of investors and 3/4 of 7 out of 10 advisors, the current low interest rates make it necessary to invest a greater proportion in stocks. Indeed, consumers, and this is in 2020, is that after COVID, a third of them say that protecting against investment losses become a higher priority. So it seems that COVID has made people more concerned about investment risk. But I think it's important to note that the proportion of people who say maximizing the potential for investment gain is a lower priority, now that for a significant part of them, protecting against investment loss is a higher priority, only 17% think it's lower priority. So for most people, they still want to get the same level of return, even though a third of them want to be more protected against risk. You can't have your cake and eat it too. Key point, in this environment, half of advisors say they need more protection they need more downside protection for their clients. And half of them say they need more equity investment for their clients, and a quarter need more of both. So there is a movement towards riskier portfolios, and also will move towards a greater acceptance of downside protection to mitigate against that risk.
And this, I should say that this creates some challenges for people too, in the sense that it isn't just that you have to look for a third direction, but when you look for a third direction, the decision-making becomes exponentially more complicated when it comes to designing a portfolio.
Thank you. It could be when we see that half of advisors think their clients need more downside protection than behind clients, because we see in a couple of different ways that there's a strong preference for downside protection. So when we ask people, what would you rather have in split sample A? And these, by the way, are pre-retirees and retirees ages 50 to 70 with assets of at least 200,000. When we ask, would you rather get only some of the gain if the investment did well, but no risk of loss to your principal if it did poorly? Or would you rather get all of the gain if the investment did well and all of the loss if the investment lost money? By 3 to 1, there's a preference for only some of the gain, but no loss. And when we put it in the form of acceptance of some risk, get all of the gain up to 15% in a year if the investment did well, but loss of no more than 9% if it did poorly, or get all the gain and all the loss, 3 to 1 again, would rather get a bounded outcome, the cap on gain and a buffer against loss. So it's our viewpoint that there's a higher risk of investing or a higher risk of not meeting a risk need, and the availability of new solutions to help, but that makes an ability to fine-tune levels of investment risk and potential for growth, but also more complex decisions.
And I should say some of the products available to fine-tune risk require a lot of different decisions like buffers and floors. And so once again, the complexity grows and there's more choices you have to consider than you used to with just a simple fixed an equity which cannot accomplish what it used to accomplish in this environment.
We think it's important to address some key characteristics of investment risk tolerance because behavioral finance tells us that reactions to risk are not totally, quote unquote, rational. One thing we found in our research is reactions to investment loss are not linear, and they increase in intensity in certain inflection points. It just doesn't go up with the level of loss, but there are some points which are especially meaningful to people where their anxiety about loss goes up at a steeper rate. To support this, Daniel Kahneman, the Nobel Prize winning psychologist, won the Nobel Prize in economics, wrote in 2009, to understand an individual's complex attitudes towards risk, we must know both the size of the loss that may destabilize them, as well as the amount they are willing to put in play for a chance to achieve large gains. We have to know how much the size of the loss that they can tolerate and the amount they're willing to put in play to gain. We also know that we can talk all we want about money invested for the long term, but fear of near-term loss is often high even for long-term investors or people who won't need the money for a while.
And Matt, I'm going to put on my psychologist hat for a second and just say that one of the big problems we have in the whole risk measurement is we're taking a psychological, a subjective measure of risk and trying to marry it to a portfolio. And we assume that everything's rational, that the person we're marrying it for has a rational view and rational and linear view of risk. And when you actually look at how people think, that's not how it works.
We do know when we ask people, and again, 200,000 above in assets, 50 to 70, that there's great variation in what the disaster point is, where people are in when they start really becoming anxious or feeling their financial security is threatened. There's also interesting that almost half of retirees and a little over a third of pre-retirees don't really know what their disaster point is, even though it's an important consideration. So there is variation and we can't make assumptions about where it is. Now, we come to this with a concern based on a lot of interviewing with advisors and consumers that discussions of risk tolerance sometimes start with investment risk tolerance questionnaires, which can lead in the wrong direction. So these are our concerns. The discussions and questions are often one-sided. They focus on loss only, and that can lead to overly conservative portfolios. We know many people are too conservatively invested. That they're sometimes based on predictions about future behavior. What would you do if the market went down 20%? That people are poorly equipped to make because people don't have a good track record of predicting their future behavior. That they're a poor communication device because they often don't facilitate a practical conversation about making specific decisions. There's not a connection often between discussions about risk and the different solutions. It's about risks often don't map to guaranteed lifetime income, even though that's often a very favorable product, or downside protection. They often just map to stocks and bonds. And in this environment, that could be suboptimal. They often lead to simplistic decisions. Oh, you're 60-40 or 50-50 that don't take into account or integrate other decisions. And those portfolios were more effective in 1990 when the fixed part was paying 8% for a 10-year treasury. That they don't incentivize clients to commit to the plan because they don't instigate or enable an effective decision about what the strategy is for dealing with investment risk and trying prudently and trying to get a good return. So we're concerned about what often takes place, not what always takes place, but what often takes place, what often the connections are. And so we want to bring forward an idea that a 5-step process be considered. Start with talking about points of discomfort and disaster point and needed level of return, risk need, how much you need to get, and use this to construct 2 or 3 portfolios. and then illustrate, based on historical performance, the likelihood of performance of 4 carefully selected outcomes, 2 positive and 2 negatives of a few portfolios. 2 where the level of market declines rarely up or down, and 2 that are more frequent. And with that information refined. So let me just give an example. And these are actually our calculations. They're a little rough. They're based on 60 years of the S&P from 1960 to 2020. Portfolio 1, which is a rough calculation, by the way, of half S&P and half a buffered annuity or ETF with a 10% buffer and a 15% cap. And the 15th percentile of loss was the S&P went down 23, and with that portfolio, roughly, the portfolio went down 18%. The 20th percentile was once every 5 years, 7% loss, 3.5% on the portfolio. 20th percentile of gain is 20%, an 18% gain for the portfolio. And the 5th percentile, which every 20 years was 30% gain, and that portfolio, half RILA, half S&P index, went up, without the dividends, by the way, went up 23%. Now, I also estimated with half in the S&P and half in a bond, I've had it paying 2%. That might be aggressive, but that's what I had. And here we see in 5% of the cases, you'd lose 13%, not 18%. So that did better. In the 20% of the cases, you would lose 2.5%, not 3.5%, roughly the same. But the upside for gain with the bond was significantly lower than the upside for the buffered product. So with 30% rise, which happens every 5%, at the 5th percentile, with the bond you gain 16%, with the buffer product 23%. So I maintain that this shows likelihoods, which is useful information, shows the trade-off, allows for fine-tuning and further discussion. So it is our viewpoint that this approach is more holistic because it shows in the same time the ups and the downs. It's interactive, it leads to a discussion, and is therefore more effective communication tools, and it maps directly to decisions, and also provides information on likelihood. Now it's based on historical, information, so that's not a predictor, but we feel it could be useful information and protect against suitability liability by not having a simplistic discussion of you 40, 60, or 50-50. And we also believe this type of approach can be applied to strategies to provide regular income. So with that is a rough tour of the implications we see in a low interest rate environment and the dilemmas it causes for individuals, for some help with downside protection, but some of the complexity. This is one idea for dealing with that and helping investors make the right decision. And with that, I open the floor for any comment, question, viewpoint, or anything else that anyone wishes to make.
Yeah, Matt, this is Frank.
Hey, Frank.
Yeah, great stuff. So just wanted to comment on something that you mentioned early on when you were going over a slide on the consumers or the investors kind of thinking more about downside protection, but still, wanting to achieve the gains. So I'm working on an annual report that we do for our members on, the state of the industry, so to speak. And part of that is an interview that I'm doing with our advisors on our advisor council. And they really very strongly echoed that, because I asked them to kind of talk a little bit about what their conversations have been like with their clients over the past year, especially since the start of the pandemic. And that is really, really there and top of mind for their clients, right? Is really scared of how far and how fast this market has come. But does it have room to run? And I don't want to miss out on that. So they're really doing that kind of delicate, dance with their clients around how to. So it's fear and greed. I probably just could have said fear and greed and stopped talking. But I just wanted to kind of mention that as something we're observing as well.
Well, thanks. I appreciate that comment, and want to add that to go too high, traditional portfolios with bonds now, on a risk of loss eventually, but also a risk of not meeting risk need. And I think that we have to be more concerned about that as well, if people not getting the returns that they need. And any other comment or question or viewpoint?
Matt, I appreciate this is really interesting info as well. I'm curious if you guys were able to go through and look at consumers who are working with financial advisors versus those who are not. And if I would imagine there's a good deal of difference in the outcomes there.
Well, I think there is, and I think in general, with one caveat, people working with advisors are more likely to have plans, more likely to have thought through things. The people who don't work with advisors are comprised of two groups. Some do-it-yourselfers who are pretty sophisticated, and some people who, really lost. But I think that's just general sense. But I think there are differences between those two populations. Also, interestingly, people who work with advisors tend to be more extroverted, and people who don't work with advisors tend to be more introverted. So there's some personality differences too.
Yep.
But thanks. Anyone else have a comment or a viewpoint or question?
Yeah, I had a quick question. So on the analysis you did, looking at the RILAs, was that all looking at 1 year returns with the 15% cap?
Yeah, I just looked at 1 year returns. And the reason for that, and I do think that there's also a use to look at longer range returns. I didn't address that because you can only do so much in 20 minutes and leave.
Yeah, gotcha.
So I think that's important. But I also believe, as I said, one of the things we have to be concerned about is that even long range investors are sometimes sensitive to risk.
Mm-hmm.
The easiest solution, the most rational solution is because, over the long term, markets recover, and you can even tell people how long it takes to markets to recover. But I do think there's some sensitivity to risk in showing a 1 year outcome, and showing the likelihood of these declines over 1 year has value. But obviously the longer range is a key.
Yeah. Thank you.
Sure. I'll give another minute. We can always, as we say in Washington, D.C., we can always yield back the time from this coffee break and let people to it. But I do want to give one more moment for anyone to raise a question or make a comment. We have these every month. We want to offer a break and try to present some information and have an interesting discussion. Anyone want to have a further discussion about this? We love talking about this. And with that, we at Greenwald wish everyone a very nice weekend. And thank you very much for attending. Take care. We are adjourned.